Welcome to the Finance Wisdom Summaries.
The Total Money Makeover, a proven plan for financial fitness. Introduction. Read this before you buy the book. Dave Ramsey opens by emphasizing that personal finance is 80% behavior and 20% head knowledge. He shares his own story of losing everything despite being a millionaire in his 20s, highlighting that his total money makeover plan is successful because it focuses on changing behavior, not just understanding numbers. This book isn't about sophisticated financial theories or secret formulas, but rather a simple, proven, step-by-step process that leads to life-changing results and financial freedom. He also addresses common criticisms, such as his confidence in a 12% annual return on investments, supported by the historical average of the S&P 500, and his inclusion of spiritual principles, clarifying that these are not wrong, but rather fundamental to his approach. The core motto of the book is, "If you will live like no one else, later you can live like no one else." Key information. Personal finance is primarily about behavior, 80%, rather than knowledge, 20%. The plan is simple and actionable, focusing on changing one's life to achieve financial success. Dave Ramsey himself experienced financial ruin and rebuilt his wealth using these principles. The book is not sophisticated, academic, politically correct, or a get-rich-quick scheme. It's a practical, proven process. A 12% annual return on long-term investments is considered achievable based on historical data of the S&P 500. The overarching motto, "If you will live like no one else, later you can live like no one else." Daily application. Self-reflection. Honestly assess your financial situation and be open to changing your financial habits, even if it's uncomfortable. Embrace simplicity. Don't overcomplicate your financial journey. Focus on practical, actionable steps rather than seeking complex solutions. Challenge norms. Be prepared to go against societal norms regarding debt and spending if you want different financial results. Long-term vision. Understand that significant financial change takes time and consistent effort, not quick fixes. Flying turkeys and skinny dipping. This section uses vivid metaphors to illustrate the dangers of poor financial habits, particularly during economic booms, and the importance of building a strong financial foundation. Ramsey recounts the 2008 economic storm as a stress test that exposed those who built their financial houses on unstable ground, debt and risky investments. He highlights that his total money makeover plan is successful because it focuses on changing behavior, not just understanding numbers. This book isn't about sophisticated financial theories or secret formulas, but rather a simple, proven, step-by-step process that leads to life-changing results and financial freedom. He also addresses common criticisms, such as his confidence in a 12% annual return on investments, supported by the historical average of the S&P 500, and his inclusion of spiritual principles, clarifying that these are not wrong, but rather fundamental to his approach. The core motto of the book is, "If you will live like no one else, later you can live like no one else." Flying turkeys and skinny dipping. This section uses vivid metaphors to illustrate the dangers of poor financial habits, particularly during economic booms, and the importance of building a strong financial foundation. Ramsey recounts the 2008 economic storm as a stress test that exposed those who built their financial houses on unstable ground, debt and risky investments. He highlights that even a turkey can fly in a tornado, meaning that bad financial ideas can seem to work in good times, but they fail when stress tested. He introduces Warren Buffett's saying, "When the tide goes out, you can tell who was skinny dipping," to emphasize that financial downturns reveal poor planning. The story of Chris, who was debt-free and had a substantial emergency fund when he was laid off, serves as a powerful example of how preparedness leads to opportunity rather than panic. Key information. Economic downturns expose faulty financial practices, much like a storm revealing poorly built houses. Stupid financial ideas like excessive debt and no savings can appear to work in good economic times, but fail under pressure. Being debt-free and having an emergency fund provides stability and opportunity during financial crises. Painful financial experiences can serve as a catalyst for permanent change. Daily application. Financial stress test. Regularly evaluate your financial situation as if an economic downturn or personal crisis were imminent. Do you have enough saved? Are you too reliant on debt? Avoid flying turkey habits. Resist the urge to overspend or take on unnecessary debt simply because times are good or everyone else is doing it.
Build your emergency fund now. The story of Chris underscores the critical importance of an emergency fund as a buffer against unexpected life events. Prioritize this before a crisis hits. Never again mentality. If you've faced financial hardship, use that pain as motivation to commit to lasting change, vowing never again to repeat past mistakes. Chapter 1, The Total Money Makeover Challenge. This chapter sets the stage for the reader's personal financial transformation by challenging them to confront their own financial realities. Ramsey shares his personal experience of feeling out of control, lost, and terrified by money worries despite being a millionaire. He emphasizes that he didn't need a get-rich-quick scheme, but rather a realization that his money problems stemmed from his own behavior, or the guy in the mirror. The core message is that winning with money is 80% behavior and 20% knowledge, and the challenge is to do what you already know you should do. The book provides a proven plan, but its success depends entirely on the reader's willingness to make sacrifices and commit to the process. Key information. The author's personal financial downfall led to his quest for financial truth and the development of this plan. Winning at money is 80% behavior and 20% head knowledge. The Total Money Makeover Challenge is about confronting and changing one's own financial behavior. The plan is not easy or fast. It requires sacrifice and discipline, but it works every time for those who commit. The motto, "Live like no one else, so later you can live like no one else," is introduced as a guiding principle. Daily application. Take personal responsibility. Stop blaming external factors for your financial situation. Recognize that your choices are the primary driver. Embrace discomfort for future gain. Understand that short-term sacrifices are necessary for long-term financial freedom. The discomfort of change is less than the pain of staying stuck. Prioritize goals over instant gratification. Use the motto, "Live like no one else, so later you can live like no one else," as a mantra to resist impulsive purchases and stay focused on your long-term financial goals. Open financial communication for couples. The Stolworthy story highlights the importance of spouses getting on the same page and communicating openly about money. Schedule regular financial talks. Chapter 2, Denial. I'm not that out of shape. This chapter identifies denial as a major obstacle to financial fitness. Just as people often deny their physical unfitness, many are in denial about their financial health, especially when surrounded by others who are also financially flabby or average. The metaphor of the frog in gradually heating water illustrates how financial mediocrity can sneak up on people without a sudden crisis forcing them to confront their reality. Ramsey argues that often it takes a financial heart attack, a layoff, a major unexpected expense to break through denial and motivate radical change. He urges readers not to wait for such a crisis, but to proactively recognize the need for dramatic change. Key information. Denial is a significant hurdle to financial transformation, making people believe they are fine when they are not. Societal norms can reinforce denial, as being average financially often means being heavily in debt. Sudden crises like job loss can be a catalyst for breaking through denial and initiating change. Gradual financial decline can be as dangerous as a sudden crisis because it doesn't trigger immediate alarm. Daily application. Honest financial assessment. Regularly review your financial statements, bank accounts, and debts. Don't hide from the numbers, even if they're uncomfortable. Avoid keeping up with the Joneses.
Recognize that many people who appear financially successful are actually deep in debt. Focus on your own financial health, not external appearances. Proactive change. Don't wait for a financial heart attack to force you to change. Be proactive in addressing bad habits now. Communicate financial reality. If you're married, Have honest, open conversations with your spouse about your financial situation, even if it's difficult. Chapter 3. Debt Myths. Debt is not a tool. This chapter systematically debunks common myths surrounding debt, arguing that debt is not a tool for building wealth, but rather a method for making lenders wealthy. Ramsey highlights how repetition and societal acceptance turn lies into perceived facts, making debt seem normal and even necessary. He presents various sub-myths, such as, debt is a tool, countered by the truth that debt adds significant risk and is not used by the truly wealthy as much as believed. Loaning money to friends or family helps them. Instead, it strains or destroys relationships by creating a master-servant dynamic. Co-signing a loan helps. The truth is, you'll likely end up repaying it, and it damages your credit. Payday loans, rent-to-own, and title pawning are needed for lower-income people. These are predatory lending practices designed to keep people in poverty with exorbitant interest rates. 90 days same as cash is free money. It's a marketing gimmick that often leads to high-interest debt, as most people don't pay it off on time and miss out on cash discounts. Car payments are a way of life. Driving reliable used cars without payments is a millionaire strategy for wealth building, saving millions over a lifetime. Leasing a car is sophisticated. Leasing is the most expensive way to operate a vehicle due to high interest, mileage penalties, and wear and tear charges. You need a credit card to build credit. You don't need credit cards for a mortgage or daily transactions. A debit card suffices, and a FICO score measures how much you love debt, not your wealth. Teenagers need credit cards to learn responsibility. This teaches financial irresponsibility and makes them a target for predatory lenders. Debt consolidation saves interest. It only treats the symptom, not the underlying behavioral problem, often leading to more debt. Borrowing against your home's value is wise. It puts your home at risk and ties you to a property you might need to sell. A debt-free society would prosper through increased savings and spending within means. Key information: debt is a tool for lenders, not a tool for building personal wealth. Societal myths normalize destructive financial behaviors. Loans to friends and family and co-signing loans often destroy relationships. Predatory lending, payday loans, rent-to-own, and title pawning targets and traps low-income individuals. Car payments and leases are significant wealth destroyers. Cash purchases of used cars are a millionaire strategy for wealth building. Credit cards are not necessary for building credit or daily transactions. Debit cards are sufficient. Debt consolidation and home equity loans address symptoms, not causes, and carry significant risks. A debt-free economy would be more stable and prosperous. Daily application: cut out credit cards. This is a foundational step. Use only debit cards for purchases. No loans to friends or family. If you want to help, give money as a gift with no expectation of repayment to preserve the relationship. Never co-sign. Understand that co-signing makes you 100% responsible for someone else's debt without any control over their payments. Avoid predatory lenders. Steer clear of payday loans, rent-to-own stores, and title pawning due to their extremely high interest rates.
Buy used cars with cash. Resist the urge for new car payments and leases. Save up and pay cash for reliable used vehicles. Challenge normality. Don't do something financially just because everyone else does it, or because it's a perceived status symbol. Beware of free money offers. Recognize that credit card rewards and 90 days same as cash schemes are designed to make you spend more and trap you in debt. Chapter 4. Money Myths, the Non-Secrets of the Rich. This chapter exposes common myths about money that often lead to risk denial or the pursuit of easy wealth. Ramsey argues that true wealth building is not complicated but requires effort and consistency, dispelling the notion of secrets of the rich. He challenges several myths. Everything will be fine when I retire. The truth is, the cavalry isn't coming. Your retirement is your responsibility, and you must save and invest now. Gold is a good investment and covers economic collapse. Gold has a poor long-term track record of returns and is not a practical medium of exchange in a collapsed economy. Get rich quickly and easily. These schemes are scams. Real wealth is built through hard work, living below your means, and consistent action.
Cash value life insurance will help me retire wealthy. These policies are poor financial products with terrible returns, high fees, and often don't pay out the savings upon death. Term life insurance is recommended
Se você
instead.
gostou do conteúdo, apoie
Playing
o
the
autor.
lottery and
Obrigado por
gambling will
assistir
make you
e não
rich.
esqueça de se
The lottery
inscrever.
is a tax
Agora,
on the
vamos
poor
para o
and
próximo
people who
vídeo.
can't do math, offering false hope. Mobile homes help you own instead of rent and build wealth. Trailers rapidly depreciate in value, making them a poor investment and a financial setback. Prepaying funerals or college expenses protects against inflation. These plans offer low returns, often less than mutual funds, and tie up your money. I don't have time for a budget, retirement plan, or estate plan. You don't have time not to. Planning is crucial for financial success. I will just file bankruptcy. It seems so easy. Bankruptcy is a gut-wrenching, life-altering event with long-lasting negative consequences for your psyche and credit. My divorce decree says my spouse has to pay the debt, so I don't. If your name is on the debt, you are liable, and it will affect your credit if not paid. Collectors are helpful and like me. Collectors are not your friends. Their goal is to get you to pay, and they may use manipulative tactics. I can't use cash because it's dangerous. You are being robbed daily by not using cash as it helps control spending. Proper insurance is vital to protect against financial devastation from unexpected events. Having a will simplifies matters for your loved ones after your death. Daily application. Plan your retirement. Start now, regardless of age, by systematically investing a portion of your income. Don't rely on others or hope for a miracle. Educate yourself on investments. Don't fall for secrets. Understand the basics of mutual funds and long-term investing. Avoid all forms of gambling. Recognize that gambling is a losing proposition designed to take your money. Smart home choices. If considering a mobile home, understand its depreciation. Prioritize saving for a traditional home that appreciates in value. Don't prepay everything. Instead of prepaying, invest the money to earn higher returns, especially for long-term goals like college or retirement. Create a monthly budget. Allocate every dollar of your income to a specific purpose before the month begins. Zero-based budget. This is your financial blueprint. Get proper insurance. Review your insurance needs for auto, home, life, term only, disability, health, and long-term care. Ensure adequate coverage to protect your financial plan. Draft a will. Don't procrastinate. Protect your family by clearly outlining your wishes for your estate and dependents. Use cash for spending. Implement the envelope system for variable expenses like food and entertainment to limit spending and create a psychological pain when parting with money. Chapter 5. 2 more hurdles: ignorance and keeping up with the Joneses. This chapter addresses 2 additional significant obstacles to financial success: ignorance and the pervasive desire to keep up with the Joneses. Ramsey clarifies that ignorance doesn't mean a lack of intelligence, but rather a lack of knowledge or know-how in personal finance, a skill that isn't naturally acquired but must be taught. He laments that financial education is largely absent in formal schooling. The second hurdle, keeping up with the Joneses, refers to the societal pressure to maintain appearances by spending money you don't have to impress others. Ramsey reveals that most millionaires live below their means, drive older paid-for cars, and prioritize financial security over outward displays of wealth. The key to overcoming this is a radical change in the quest for approval, understanding that the Joneses are likely broke themselves. Key information.
Ignorance in finance is a lack of taught knowledge, not intelligence. Financial education is crucial for personal wealth building and is often overlooked in traditional schooling. Keeping up with the Joneses is a destructive financial habit driven by the need for external approval and leads to debt. Most millionaires live frugally, prioritizing saving and investing over lavish spending. Overcoming the need for external approval is a critical, heart-level change for a total money makeover. Daily application. Seek financial knowledge. Actively learn about personal finance through books, podcasts, or courses. Dedicate time to understanding how money works.
Prioritize financial fitness over appearances. Don't let the desire to impress others dictate your spending. Focus on building actual wealth, not perceived wealth. Budgeting as a tool for control. A budget helps you tell your money where to go, allowing you to prioritize your financial goals over impulsive spending driven by social pressure. Challenge family spending habits. Be prepared to deviate from family traditions, e.g. gift giving, if they are financially detrimental. Sarah's story of changing Christmas traditions is a strong example. Reevaluate your car. Dave's personal story about his Jaguar highlights the importance of not letting cars be an idol. Drive reliable, paid-for used cars to free up income for wealth building. Chapter 6. Save $1,000 fast. Walk before you run. Baby step 1. This chapter introduces the crucial first baby step, saving $1,000 as a starter emergency fund. Ramsey explains that the baby steps are designed for focus and quick wins, preventing people from feeling overwhelmed and losing motivation. He emphasizes that this initial $1,000 is not for investing or vacations, but solely for emergencies, a rainy day fund. The purpose is to break the cycle of using credit cards for unexpected expenses, which often derail financial progress. To achieve this quickly, Ramsey encourages radical actions like selling possessions, working extra hours, or having garage sales. This fund should be liquid and easily accessible, not tied up in investments. Key information. The baby steps provide a sequential, focused approach to financial freedom. Baby step 1 is to save $1,000 or $500 for lower incomes as a starter emergency fund. This fund is only for emergencies and prevents using debt for unexpected events. Achieving this step quickly provides a quick win and builds momentum for the rest of the plan. Radical actions, selling items, extra work, are encouraged to hit this goal fast. The money should be kept liquid and accessible, not invested. Daily application. Immediate action. Stop all non-essential spending and focus intensely on saving $1,000. This might mean temporarily pausing retirement contributions unless there's a company match and other savings goals. Sell something. Look around your house for items you can sell to quickly generate cash for your emergency fund. This could be anything from unused electronics to a second car. Increase income temporarily. Consider taking on a temporary side job, working overtime, or delivering pizzas to reach the $1,000 goal faster. Zero-based budget. Implement a monthly zero-based budget, giving every dollar a name to help you find extra money for your emergency fund. This helps you control where your money goes, rather than wondering where it went. Keep it separate and liquid. Store your $1,000 in a separate, easily accessible savings account, ensuring it's not linked for overdraft protection or invested in anything with penalties. Chapter 7. The Debt Snowball. Lose weight fast. Really. Baby Step 2. Baby Step 2 is the debt snowball, a powerful method for paying off all non-mortgage debt. The strategy involves listing all debts from smallest to largest balance regardless of interest rate. You pay minimum payments on all debts except for the smallest, on which you pay as much as possible. Once the smallest debt is paid off, you take the money you were paying on it and add it to the minimum payment of the next smallest debt, creating a snowball effect. Ramsey emphasizes that this method prioritizes behavior over math. The psychological quick wins of paying off smaller debts first provide the motivation and intensity needed to stay committed to the plan. Even if mathematically, paying the highest interest rate first would save slightly more money over time.
He encourages gazelle intensity.
an urgent, focused approach to eliminate debt quickly. Key information. Baby step 2 is the debt snowball, paying off all non-mortgage debt from smallest to largest balance. The snowball principle involves rolling the payment from a paid-off debt into the next debt on the list. This method is primarily a behavioral modification tool, providing psychological quick wins to maintain motivation. Gazelle intensity, an aggressive, focused effort, is crucial for rapid debt elimination. Temporarily pause all retirement investing, except any employer match, and college savings during this step to maximize debt payoff. Daily application. List your debts. Create a detailed list of all your debts, excluding your mortgage, from the smallest balance to the largest. This visual representation is powerful. Attack the smallest debt. Dedicate every extra dollar you can find, from cutting expenses, selling items, or extra work, to the smallest debt. Celebrate wins. Acknowledge and celebrate each debt payoff. This reinforces positive behavior and fuels your motivation. Increase income. If your budget is tight, actively seek ways to increase your income temporarily to accelerate the debt snowball, for example, side hustle or overtime. Avoid new debt at all costs. Do not take on any new debt during this phase. If an emergency arises, use your $1,000 emergency fund, then replenish it before resuming the debt snowball. Open communication with spouse. Discuss financial decisions openly and ensure both partners are fully committed to the plan, as highlighted by Jeff and Teresa Eller's story. Chapter 8. Finish the emergency fund, kick Murphy out, baby step 3. Once all non-mortgage debt is eliminated, baby step 3 focuses on fully funding your emergency fund. This means saving 3 to 6 months of essential living expenses. Ramsey refers to Murphy, as in Murphy's Law, if it can go wrong, it will, and explains that a fully funded emergency fund protects you from life's unexpected events, preventing you from resorting to debt when crises hit. The size of the fund depends on factors like job stability and spouse's comfort with risk. Those with less stable incomes should aim for 6 months. This fund should remain liquid, in a money market account, not investments with penalties, and only be used for true emergencies, not wants or anticipated expenses. This step provides immense peace of mind and turns crises into mere inconveniences. Key information. Baby step 3 is to fully fund your emergency fund with 3 to 6 months of living expenses. This fund acts as a buffer against unexpected life events like job loss, car repairs, or medical emergencies, without resorting to debt. The amount to save depends on your income stability and comfort level. The money must be liquid, e.g. a money market account, and accessible, not invested for growth. Clearly define what constitutes a true emergency to avoid misusing the fund. Daily application. Calculate your needs. Determine your monthly essential expenses, food, housing, utilities, transportation. Multiply this by 3 to 6 to set your emergency fund goal. Continue gazelle intensity. Apply the same intensity used in the debt snowball to build this fund quickly. Every extra dollar goes towards filling this bucket. Distinguish needs from wants. Be disciplined in what you define as an emergency. A broken appliance might be an emergency. A new gadget is not. Open communication on fund usage. If married, always discuss and agree with your spouse before touching the emergency fund. Replenish after use. If you use part of your emergency fund, immediately pause other financial goals, like investing, and refocus on replenishing the fund to its full amount. Delay home purchase, if applicable. Do not buy a home until this step is complete, as a fully funded emergency fund provides crucial stability for homeownership. Chapter 9. Maximize retirement investing. Be financially healthy for life, baby step 4. With debts gone and a full emergency fund, baby step 4 marks the transition to aggressive wealth building, investing 15% of your gross household income into retirement. Ramsey defines retirement not necessarily as quitting work, but having security and choices because your money works for you. He dismisses relying on Social Security and stresses individual responsibility for retirement planning. He recommends investing evenly across 4 types of growth stock mutual funds: growth in income, growth, international, and aggressive growth. The focus is on long-term, consistent investing, emphasizing that compounding interest over decades is the true secret to wealth. He advises taking advantage of employer 401k matches first, then fully funding Roth IRAs, and then finally, contributing more to 401ks or other plans to reach the 15% goal.
Daily application. Calculate your 15%. Determine 15% of your total household gross income. This is your monthly investment target. Set up retirement accounts. Open or adjust your 401k, 403b, Roth IRAs, or other retirement plans to direct the 15%. Automate investments. Set up automatic contributions from your paycheck to ensure consistent investing and remove the temptation to spend the money. Diversify broadly. If investing in mutual funds, spread your money across the 4 recommended categories to reduce risk. Stay the course. Resist the urge to jump in and out of the market based on short-term fluctuations. Focus on the long-term growth of your investments. Start early. The power of compounding means the earlier you start, the less you need to save each month to reach your goals. Chapter 11. College funding. Make sure the kids are fit too. Baby Step 5. Baby Step 5 focuses on saving for children's college education, but only after retirement investing is well underway. Ramsey challenges the societal pressure to go into massive debt for college, emphasizing that a college degree is a want, not a need, and its value depends on the student's character and diligence. He firmly advocates for avoiding student loans, calling them a cancer. Instead, he suggests strategies like attending community college first, living at home, applying for numerous scholarships, including local non-academic ones, work-study programs, and even military service. For savings, he recommends education savings accounts as the primary vehicle due to their tax-free growth and flexibility, followed by flexible 529 plans. Key information. Baby Step 5 is saving for college, but only after Baby Step 4, retirement investing, is fully funded, 15% of gross income. Student loans are strongly discouraged due to their long-term negative impact. College is viewed as a want or luxury, not a necessity, and its value is enhanced by student character and hard work. Strategies to pay for college without debt include community college, living at home, scholarships, academic, athletic, and local/small, work-study programs, and even military options. For savings, he recommends ESAs, education savings accounts, as the primary vehicle due to their tax-free growth and flexibility, followed by flexible 529 plans. Daily application. Prioritize retirement first. Ensure you are consistently investing 15% of your gross income for your retirement before actively funding college savings. You can't retire from your kids' college funds. Discuss college expectations. Have open conversations with your children about realistic college options and the importance of avoiding student loan debt. Research affordable options. Explore community colleges, in-state public universities, and schools where your child might qualify for significant financial aid or scholarships. Aggressively pursue scholarships. Encourage your children to apply for a wide range of scholarships, not just academic or athletic ones. Many smaller local scholarships go unclaimed. Open ESA accounts. Set up and consistently fund an ESA for each child, taking advantage of tax-free growth for education expenses. Consider creative funding. Brainstorm with your children about unique ways to earn money for college, such as high-paying summer sales jobs or work-study programs. Chapter 11. Pay off the home mortgage. Be ultra-fit. Baby Step 6. Baby Step 6 is paying off your home mortgage early, marking the marathoner status in your financial journey. At this point, you have no other debt, a fully funded emergency fund, and are investing 15% for retirement and saving for college. Ramsey challenges the conventional wisdom to keep a mortgage for tax deductions or investing the extra money is smarter, explaining that the tax deduction myth encourages you to send significantly more money to the bank than you save in taxes. He also argues against borrowing against your home to invest, emphasizing the inherent risk. The goal is to eliminate all payments, freeing up your largest wealth-building tool, your income, to build wealth like Arnold Schwarzenegger. He advocates for fixed-rate 15-year mortgages if you must borrow, but ideally paying cash, 100% down plan. Key information. Baby step 6 is paying off your home mortgage.
Key information. Baby step 6 is paying off your home mortgage early. This step should only be pursued after all other debts are paid, emergency fund is full, and retirement college savings are on track. The tax deduction myth is debunked. Paying mortgage interest to get a tax deduction means you're still losing money. Borrowing against your home, like a home equity loans, ARMs, or balloon mortgages, for investment is highly risky and often leads to financial ruin. The ideal scenario is to pay cash for a home, the 100% down plan. If a mortgage is necessary, a fixed-rate 15-year mortgage is recommended, or making extra payments on an existing loan as if it were a 15-year one. Daily application. Extra mortgage payments. Dedicate every extra dollar beyond your existing baby steps, 15% retirement, college savings, to paying down your mortgage principal. Attack with intensity. Approach paying off your mortgage with the same gazelle intensity used for the debt snowball. Rethink refinancing. Only refinance if you can significantly lower your interest rate and break even on closing costs within a few years, and always opt for a fixed, shorter term. Avoid risky mortgage products. Steer clear of adjustable rate mortgages, ARMs, and balloon mortgages which transfer interest rate risk to you. Don't borrow against your home. Resist the temptation to use your home as a piggy bank through home equity loans, even for emergencies. Your emergency fund should cover those. Envision freedom. Focus on the peace and freedom that comes with having no house payment, knowing that every dollar of your income will be truly yours to build wealth and give. Chapter 12. Build Wealth Like Crazy. Arnold Schwarzenegger, Mr. Universe of Money. Baby Step 7. This final baby step, Build Wealth Like Crazy, positions you as Arnold Schwarzenegger, Mr. Universe of Money, completely debt-free with a fully funded emergency fund, aggressive retirement savings, and college funds. At this stage, your money starts working harder than you do, reaching the pinnacle point where your investment income can cover your living expenses. Ramsey outlines 3 primary uses for money at this level of financial fitness: fun, invest, and give. He emphasizes that true fulfillment comes not from accumulating wealth for its own sake, but from being able to enjoy life, invest more, and especially give generously. This is where wealth becomes a blessing, enabling you to make a significant impact on others' lives and leave a lasting legacy. Key information. Baby Step 7 is to build wealth like crazy, achieved when completely debt-free, including mortgage, and having all other baby steps in place. At this stage, your money works harder than you do, allowing you to live off investment income, the pinnacle point. The 3 main purposes of money are fun, invest, and give. Materialism, affluenza, is a danger to avoid. True joy comes from purpose beyond accumulation. Giving is a crucial aspect of living a fulfilling financial life, enabling significant impact on others and leaving a legacy. Daily application. Invest more aggressively. Continue and increase your investments beyond the initial 15% for retirement. Explore additional investment opportunities such as real estate or business ventures. Enjoy your money responsibly. Allocate funds for enjoyable experiences, hobbies, and purchases, knowing that you've earned it and it won't derail your financial stability. Give generously. Prioritize charitable giving. Identify causes you're passionate about and contribute financially, experiencing the joy and impact of generosity. This should be a continuous practice even from earlier baby steps. Mentor and teach. Share your financial wisdom with others, especially your children, to help them avoid financial mistakes and build their own wealth. Avoid complacency. While celebrating your achievements, remain vigilant against debt and poor financial habits. Continue to budget and manage your money intentionally. Live with purpose. Recognize that financial freedom is a tool to pursue your passions and make a positive difference in the world, not an end in itself. Conclusion. Live like no one else. The book concludes by reiterating that the Total Money Makeover is a proven plan that leads to wealth and financial freedom, but it comes with a problem: the risk of becoming enamored with wealth itself. Ramsey emphasizes that money is not evil, but the love of money can be. True fulfillment doesn't come from possessions. He who dies with the most toys is still dead, but from living a life of purpose, generosity, and strong character. The ultimate goal of the Total Money Makeover is to transform your entire life, financially, relationally, and spiritually, so you can live with hope, build a legacy, and give beyond your imagination. By living like no one else, you achieve the ability to live like no one else, a life of true financial peace and impact. Main idea of the book.
The Total Money Makeover by Dave Ramsey presents a straightforward, actionable plan to achieve financial freedom by addressing destructive money behaviors and societal myths. Emphasizing that personal finance is 80% behavior, Ramsey guides readers through 7 baby steps: saving a starter emergency fund, eliminating all non-mortgage debt via the debt snowball, fully funding an emergency fund, investing 15% of income for retirement, saving for college, paying off the home mortgage, and finally, building wealth and giving generously. The core principle is live like no one else so later you can live like no one else, advocating for radical discipline and sacrifice now for a future of financial peace, security, and the ability to enjoy money and impact others. This proven system empowers individuals to take control of their finances and transform their lives.
If you enjoyed the content, please consider supporting the author. Thanks for watching, and if you like this video, subscribe. Now, let's go to the next